Hello, I'm Andrew Van Sickle, editor of MoneyWeek magazine. Thank you very much for joining us at this webinar, which is the first in a series of 3 with Allianz Global Investors. Now, back in 2000, when we set up MoneyWeek, one of my first tasks was to compile the .com disaster of the week column. Both MoneyWeek and the tech sector have come a long way since then, but where is the sector going? So to help us answer that question, we're very lucky to have Mike Seidenberg with us today. Welcome, Mike.
Nice to see you. Interestingly enough, I worked for one of those .com disasters, so very familiar with your column.
Thank you. Mike is the lead portfolio manager of the Allianz Technology Trust, which manages assets worth about 1.3 billion and has risen by about 518% in the last 10 years, comfortably outperforming its benchmark, which is the Dow Jones World Technology Index. Now, Mike joined Allianz in 2009, right at the beginning of the long bull market. Fantastic timing, Mike. And the big question, of course, is now that the market has gone into reverse, what happens next? So Mike is going to give us his assessment of the state of the market. And after that, we will drill down into some intriguing subsectors and the opportunities for investors there. So Mike, starting with the big key question really, is the tech bear market over? Because a lot of our readers and viewers will remember when we set up all the bear market rallies we saw in 00 to 02. What's your take after a really, I'm guessing, rather unpleasant 2022?
Yeah, it's something I spend a lot of time thinking about and trying to make sure that the trust has the right stocks for the themes and for the drivers that we're seeing in technology. Look, if I take a step back and just think about where technology is today versus coming out of the last global recession in the 08 timeframe, I think fundamentally technology is just such a large part of our lives that this has been a challenging period, no doubt, for technology companies. But overall, if you think about the competitive advantage that technology affords the customers who use it and implement it, I don't think this sector is one that, is going away. I will tell you, as I think about, investing going forward, I think you're going to have to be much more specific with respect to subsector allocation, with respect to owning companies and thinking about budgetary cycles. Look, the past year and a half-ish has really shown us as companies, as companies tighten their belt, they really have to reallocate capital differently. And that requires hard decisions. And when hard decisions are made, companies usually make them making sure that they really are spending against motives and opportunities that really matter to them. Excuse me. So I apologize for that. So I don't think, I think technology is from a long-term perspective remains a really robust sector, but it's going to be more of a stock picker's market. I think you're going to see more zigs and zags. And when things return to just better budgetary spending, I don't think it's a rising tide lifts all boats, like which we saw in the pandemic, where companies just had no choice but to get their employees online and productive, and that benefited both next generation companies and legacy companies. And remember, since I've mainly been talking about kind of software in this piece thus far, remember we have things like the movement to electronic vehicles, driving the semiconductor companies. All companies want to meet their customers digitally because you and I live on smartphones, and that's where you want to meet your customer where they want to be met. So I think there are a lot of interesting things happening in technology, not to mention cybersecurity and some of the other, but I still see a variety of interesting opportunities. But you're going to have to be choosier, and you're going to have to be more disciplined with respect to thinking about companies being profitable sooner.
Yeah, it certainly seems, and we're certainly past the era of, say, justlightbulbs.co.uk, as you correctly point out. We have a great secular story in lots of the tech sector now. As you say, we're going to have to be a lot choosier. One thing that strikes me is that, of course, the pandemic meant we borrowed quite a lot of growth from the future. If you look at the revenue figures of some of the big tech folks, big tech companies, they've gone back to pretty pedestrian levels as opposed to absolutely rocketing during the pandemic. So there's always that matter, I suppose, of, some companies have borrowed growth from the future. And as you say, generally speaking, we need to be choosier. So we'll come on to the sectors a little later as well. What readers will also be curious about is, given the environment, which we see big picture wise as rather stagflationary, pretty slow, that does not, of course, rule out fantastic structural growth stories, which tech very much is. But as you say, we've got to be picky. In terms of the market headwind, what people are intrigued by is, our take is that inflation is going to be a lot stickier than many people think. I don't know if you saw the Deutsche Bank note last year that chewed through 200 occasions when inflation had reached more than 8%. And the big picture was that on average, it tends to come down only to about 6%, and then it hangs around there for a few years, which is a very interesting structural observation, which means that interest rates are probably not going to fall as quickly as many people would like. And of course, when we're talking growth stocks, the problem is that, there's the discounted cash flow model. There's this business of the future earnings are worth a lot less now when the interest rates are high. What is your take on that kind of headwind in terms of the market and how it might impact whether we are now in a bear market rally, or whether we can just get going again with our secular bull market?
Well, I think you're going to have to think in terms of underwriting your companies or underwriting the stocks you own in a different modality. We've already done that. We've adjusted for a higher cost of capital, i.e., higher interest rates, and thinking about discounting back future cash flows. But remember, at the end of the day, many of these technologies are deflationary, right? So if you think about it, if you have rising wages and you make your employees more productive vis-a-vis software, which has traditionally been the case, that's a deflationary tool. So going back to my earlier comment that, you're going to have to find sectors that really play in to helping companies do more with less. I think software is one of those sectors. It makes, I often remind people, companies buy software for three reasons, right? Either to sell more things, take costs out, or create, happier, higher customer satisfaction, right? And all of those things persist today, given that you just need to do more with less. And this notion, excuse me, of technology being deflationary persists. I don't think just because that exists doesn't mean companies are going to go out and spend gazillions of dollars with a given provider. But if you can build a business case, if you can show an ROI, a lot of the things that we focus on, return on investment, sorry, I try not to use too many acronyms. A lot of the things that we try to solve for in our mosaic approach to investing, we are out there talking to chief information officers, talking to system integrators, going to user groups, and we really want to listen and figure out, is product XYZ the products that's going to garner those dollars? I don't think spending grinds to a halt. I'll also tell you the other side of this coin from my perspective is that companies, if you think about just, if you think about a boxer, which may not be the best analogy, and a boxer, who's had a lot of easy rounds in their career and now has a more challenging fight on their hand, they typically train harder, right? They're in better shape. A lot of these companies are going to come out this period in better shape from our perspective, right? More operationally efficient. And sometimes what happens is when you actually shrink an organization and empower people to do more, they actually execute better. I lived through that at Oracle when I came out of business school. I was there kind of right post one of their challenging periods. And it was amazing as we actually got smaller, how much more stuff we got done. I think there are puts and takes, but generally speaking, we've always invested in the trust with kind of, mosaic orientation around subsectors, and then with a macro overview. And that's not going to change. We do care about the macro, and it's something we're very cognizant of as we're thinking about investing in technology.
I think it's a very interesting sort of juxtaposition, really, to have this ongoing story that tech can help deflation with productivity, among other things, but also it's probably structurally slightly more inflationary environment in terms of, deglobalization, onshoring, reshoring. So what I'm hearing here is that there's a certain amount of long-term opportunity in the companies that can help resist the inflationary headwind, really. I think that sounds like an intriguing take.
I mean, that's definitely what we're hearing, and it's our belief, and it's part of our job. Obviously, we do a lot of research, but if you talk to customers of products that really help their businesses, you consistently hear similar themes, right? Wow, our our net promoter score went up, our XYZ is better, and that's a result of an implementation of technologies. And don't forget, against the backdrop of all of this, you have things like cybersecurity, which in my mind, whether the economy is good or bad, the adversaries just get increasingly sophisticated, right? Yep. So we're living in an era where, I always remind people that smartphones are amazing, right? They've made our lives easier. They've made, you become much more digital. You can, go look at the high street retailer prior to walking down that street to figure out what you want. And you may even pre-order something, but you also become more vulnerable, right? Because you become a target on a network from a cybersecurity perspective, and the adversaries are really, really sophisticated.
So in a way, technological progress will beget more progress, because the progress will also cause some vulnerability, and there's some scope for addressing it too.
It's just a trade-off, right? If you want to embrace things that if you want to embrace technology as a consumer, in this case, we're speaking consumer to consumer, but don't forget, companies like John Deere, are really, their equipment in the field now is very connected. And I think I read an interesting stat that, they're seeing their buyers who used to spend time, going to showrooms and looking at catalogs, or showrooms, probably the wrong analogy for a piece of farming equipment. But
tech is intriguing, yeah.
Yeah. So, they're meeting here again, it goes back to that idea of you want to meet your customer where they want to be met. And that persists across business to business, business to consumer. And I just think that's a real important, it's a real important mantra to win, if you're a company. I think if you and I started a company today, our goal would be, how do we sell whatever we're going to sell in the way that takes the least amount of friction out of that sale, right? The less friction you have, the better opportunity you have to create that customer for life.
Yeah. Okay, before we drill more into the sectors and the fund, I just wanted to get your thoughts on valuations. That's something that is always associated with tech. We remember the days of 100 times earnings, but no actual earnings,
yeah,
that kind of thing. They look much more reasonable now, generally speaking. Could they still be a bit of a headwind? I mean, it will be part of the psychology when investors assess tech, always valuation.
I mean, they're much more reasonable today than they were, 18 months ago, even a year ago. I mean, if you think about, what we've gone through, we've seen a real downdraft on valuations. I looked at an interesting slide a couple of weeks ago that showed the average software company, looking at it from an EV to sales basis, kind of where it was and where it is today. So, and it was interesting. The thing that jumped out at me was today's valuation, and I think it was about 5.7 times in the slide I was looking at, EV to sales. That is back to 2017 levels. So if I knew nothing about software whatsoever, and I said to myself, is software more or less relevant today than in 2017? The answer, in my mind, is 100% yes, right? We're much more dependent on it. We're much more likely for companies to buy these products to kind of help their businesses. So, I look at a valuation metric like that, and I say to myself, wow, this is interesting, right? I mean, even if and obviously this is an average, but it kind of speaks to kind of where we are today. And looking forward, I don't think the spending goes away. I really don't. As I alluded to earlier, I think you're going to see reallocation within subsectors, but people are going to spend on technology. And you're right, interest rates are higher, so that business case that company needs to provide to its customer to buy something needs to be tighter, needs to be more robust, and we're seeing that.
Well, we have much more reasonable price to sales and price to earnings ratios. It seems
100%.
like I think they're reasonable enough for the average nervous retail investor to think, oh, well, maybe I should buy some tech now, or maybe I should buy along a good structural story, which we'll come on to in a minute, as in, being selective, of course. But generally speaking, do you think the valuations are much more enticing?
I am cautiously optimistic about where we sit today, knowing that things probably get easier from a comp perspective, so from a comparable numbers perspective, as we work our way through the year, that 24 is in all likelihood is a year where companies probably, they're going to be used to what the new normal is. And therefore they may be more a little looser with the IT budgets. So I am optimistic cautiously. I also would remind every investor on this call that if you have a long-term perspective, this is a sector that over time has driven a lot of capital appreciation. So, and I don't think that changes. And I think that, I lived through, I worked in the .com. I lived through 0809. This is not 0809. I mean, I can remember those very vividly, those times when, people wouldn't return phone calls. You talk to companies and literally you'd hear comments like, we can't get a return phone call. We're not seeing that. Honestly, some of the results, the results coming out of Q1 for a lot of the tech companies have been pretty solid. Solid, if not, better than feared. So, here again, cautiously optimistic, but from a long-term perspective, this is a sector where you want to be. I mean, this is a sector where, there's growth. The models are very profitable at scale. So, that's my perspective on it.
I'm always reminded that Keynes said in the long term, we're all dead, but tech has the ability to keep us alive and make our life interesting. So there's certainly that.
That's funny.
So in the drilling down a little bit, I mean, I'm guessing that you see more opportunity in the mid and large cap area, given that you don't focus on the mega caps like some funds.
Well, let me be really clear. We spend a lot of time on the mega caps. We just tend to be structurally underweight them, given that, they are such a large percentage of our benchmark, and we have a very active board who really wants to make sure that, we have the correct position size, that we don't have too big a position, which, by the way, I 100% agree with. I mean, I think the last time I checked, Apple was, 16% of our benchmark or thereabouts, and we're not going to have a single stock position at 16%. I don't feel like that would be responsible for our shareholders. So, what we traditionally have, our success has traditionally been predicated on the ability to find companies that are kind of in this kind of mid cap oriented space that really have secular aspects to them. So whether that's security, whether that's the cloud, whether that, today it's thinking about artificial intelligence, our process really lends itself by being in San Francisco, which we think is a competitive advantage over time. We really think that, we have the ability to identify the companies at a subsector level, and invest in them kind of before the rest of the world. And look, year to date, the mega caps have done well. So it's actually been a headwind against the trust. So, it just over time, traditionally, we've been able to find companies that offset the mega cap growth and outperform our benchmark.
Okay. Well, you remember how they always say that a new bull market is not led by the leaders of the last one. So if the mega caps are charging ahead, you're probably better off outside that subsector for now. I think it's time we can now drill into some interesting subsectors. Before we do, though, I noticed that the trust has been talking about labor shortages driving automation, which strikes me as a very interesting structural idea. Will you tell us a bit about that and how it underpins your secular choices elsewhere?
Yeah, I mean, so here again, if you think about what we've heard a lot of, what we all experienced in the pandemic, were supply chains that there's both supply chains that you couldn't get the goods and services, and not enough people, right, to kind of work in some of those jobs. So and I don't have the slide in front of me, but there's a great slide that shows that for most major industrialized countries, we're X growth from a population perspective, and changing population is difficult. So therefore growing population is difficult. Therefore you need to automate more. And one of the things we've looked at is just additional automation of factory floors, in kind of ways to monetize that. I'll tell you, I like the idea as a theme in the portfolio today. It is not, incredibly well represented, primarily because we just haven't gotten the value. We haven't had the valuations work for us in that sector. But I do believe that as more and more businesses onshore, as we're seeing in the United States, with semiconductor facilities being built here to mitigate some of the supply chain challenges, you'll see more automation, right? It's really the only way that a first world industrialized country can compete effectively is to just offset, inherent labor disadvantage with more automation advantage, if that makes sense to you. So I like the thesis. It hasn't been as easy to find, first and second derivatives from a stock perspective, but it's something that I think that a lot of the other things that are in the portfolio kind of play into, right? But maybe less of a pure play on the automation of a factory floor today.
Well, talking of automation, I suppose that leads us to AI, because the increasing sophistication of automation is very much where we're going. I love to threaten younger journalists with ChatGPT. And I still don't understand why we don't have robots to do ironing, but that's another story. But let's talk a little bit about AI. And I know that it's actually not always the most straightforward sector for people to grab things in. And I gather that you are quite keen on the pick and shovels approach here, so to speak.
I mean, traditionally, if you think about a nascent sector where, things are still being, discovered, which I would argue artificial intelligence is, one of the best ways to monetize it has been through kind of, what I call first derivative, right? And if you think about it, if we use a gold mine analogy, you could own the claim, or you could own, picks and shovels, as you alluded to. I really like the picks and shovels idea because I think that the ubiquity of artificial intelligence and the interest that we're seeing across all verticals really lends itself to people wanting to try it out, right? Whether or not they're successful, who knows? But I think a lot of the chatter on it is so high right now. And I have a good story I can tell you. I was at a basketball game a few weeks ago with a friend of mine who runs, he's the chief innovation officer for a large health maintenance organization, huge one. He's a surgeon by training. And I sat with him at the game, and I said to him, talk to me about AI. How real is it? And his eyes just lit up. And he went on like probably a 5 to 10 minute story saying how they're going to improve healthcare outcomes, decrease the costs, and improve customer satisfaction. And, when you hear stuff like that, it really perks your ears, right? Because this isn't someone who's, into the hype cycle. He's just trying to. Exactly. So when you hear stuff like that, you say to yourself, wow, this is really real. So, owning something like an NVIDIA really puts ourselves in a position to let other vertical industries figure out how they apply artificial intelligence to their problems by just owning the infrastructure, basically, right? We're owning the infrastructure, and NVIDIA is doing some really clever things with respect to...
Essentially, it's a chip maker, isn't it? So what you're saying is if you buy the tools, so to speak, how the tools are used is not the biggest drama here. It's really more about buy the tools, everyone will need the tools.
Correct. And they are going to try to deliver one of the things they talked about at their last investor day was their plan is to deliver artificial intelligence compute as a service. So they would have a cloud-based service. And that's super interesting to us. So, here again, nascent TBD on whether they get, but, in our opinion, today, they are a very clean way to play the emergence of artificial intelligence.
Coming back briefly to the medtech angle, there's all these, these visions of these arms of robots doing operations and everything. Are there any companies in that subsector that you're looking at that you have invested in?
Well, just to be clear, we have not traditionally invested in medtech. I follow it peripherally just because I think intellectually, whether it's Intuitive Surgical or the likes, I mean, I find it intellectually very fascinating, but it's not a sector where we tend to invest in, given the kind of specialization with respect to kind of the science aspect. We haven't gone down that path.
We've often mentioned Intuitive Surgical to readers, so I was just intrigued to know whether you guys look at it as well. Coming on now to cloud computing, that's the kind of thing that is absolutely mushrooming. What is your take on that, and how quickly it will develop?
I mean, the interesting thing about cloud computing, and we've been talking about it for a long time, is we're still only about 19% penetrated as of 2022. That was the last stat I looked at. So what's happened thus far is most development and test workloads have been used in the cloud, and now we're moving to production. And production is really kind of where it matters. So even though we've been talking about it for a long time, it's still a big opportunity set out there for companies to move their workloads from these kind of proprietary on-premise workloads to the cloud. So remember, when you move to the cloud, with that comes increased spend around cybersecurity and a variety of peripheral services. So, look, it's very clear to me the value proposition of the cloud. If you're a board of directors, you look at it and you say, more secure, cheaper, I'm not stranded with legacy technology. That's a win for the organization. We're more nimble, et cetera, et cetera. So, here again, still relatively under penetrated. So good growth opportunities looking forward over the next 5 to 10 years there.
It's essentially a matter of, I was trying to explain it to my grandfather, because sometimes he's not very techy. So it's essentially it's a matter of taking your costs and putting them up in the sky, as it were, for somebody else to look after. Right? You don't have your own software; you rent your own software from the cloud. That kind of thing.
Yeah, I mean, I also think of it, here again, just a simple analogy is you're taking fixed costs of organizations, right? I mean, I worked at Oracle after business school. Our customers invested massive amounts of money in hardware and storage to run our applications, right? With the cloud, you take that equation out of it. You replace that fixed cost with a variable cost, right? The variable cost being compute and storage to run those applications. So it's such a win in that you don't get stuck with this kind of, so many decisions previously in IT were made based on, we've already invested in this. Do we really want to go down the road of having to, jettison all this equipment, et cetera, et cetera? You just take that off the table.
Someone else's equipment. And
exactly. Let somebody else worry about the technology stack, and you, Mr. Customer, figure out what your organization does best.
Okay. So it's a matter of outsourcing, essentially.
Well, I mean, outsourcing, but also just it's optimization, right? Like, are you really better at orchestrating technology than the Amazon? And the answer is probably no. No. Most organizations
the comparative advantage very much lies with Amazon, yes. So it is really, who are the biggest cloud players? It's essentially the big guys, and sometimes it comes out of nowhere. Like Microsoft appears to have developed a pretty decent cloud business just like that. When everybody was complaining about Internet Explorer, they suddenly got on with something good.
I mean, they've done an amazing job as an organization. Excuse me. The big players are the likes of whether it's, Amazon, Microsoft, Google, and there's some periphery players. But the big three are really the ones that kind of own the space today. And depending on your use case, you might choose one versus the other. But it's a tremendously large market. So there's definitely room for three players.
It's also the big guys, coming on to the next interesting subsector. It's also the big guys who tend to be the big cybersecurity experts, don't they?
Yes and no. I mean, look,
I get the impression that's a bit of a dumbbell market where you've got a cluster of the big guys and then not much in the middle, but a cluster of the small guys.
I think a little bit, although, we are seeing the likes of a Palo Alto network, which is becoming, has a chance to be the first large cap security, pure play security vendor. But if you think about security, traditionally, because the vectors change, right? The adversaries are constantly changing vectors. So you and I might spend money trying to thwart a certain attack as a company if we were a security company, and then the adversaries go in a totally different angle. There isn't this natural learning curve, right? If you think about it, and I'll use the analogy, having worked at Oracle innovated for 40 plus years on the database. With cybersecurity, there isn't that ability to innovate on the core technology because your adversaries change vectors. And therefore, I think it's such an important sector where you really have to have kind of domain expertise knowledge. Now, in fairness, the likes of a Microsoft, which is a real relevant security player, they've really, they are very legitimate and very relevant in security today. But outside of Microsoft, a lot of the other organizations, whether it's Google or whether it's Amazon, if you think of the larger mega cap companies, they really push back the security burden to their customers, right? So if I use Amazon Web Services, there's some rudimentary security there, but me as a customer, I also have my own security. So it's kind of a shared responsibility model.
It's an interesting area because it reminds me a bit of counterterrorism in the sense that you have to you're always chasing the bad guys to some extent, and sometimes you will anticipate them, but you only have to be wrong once, right?
Yeah, and the biggest challenge is, just getting back to some of our earlier comments, was there's a scarcity of people to fill the job recs in cybersecurity, and false positives, which means you and I spend our resources tracking down something that really isn't a breach. Meanwhile, like somebody's going in the back door, right? So, there's this kind of notion of scarcity of employees coupled with a lot of cycles being spent on false positives result in a real opportunity set for the companies that participate in this market.
Okay, I'm guessing you keep reading that when it comes to the Internet of Things, the security is quite rudimentary, and that's a very nascent area that people consider vulnerable to cybersecurity threats.
I mean, I think that just the notion of if you think mathematically, the more nodes on a network, the more vulnerable you are. The Internet of Things expands on the nodes, right? And therefore, you need to have a solution to make sure that you have a response to that particular vulnerability.
I think that that's the one area that people often have trouble, putting their finger on or pinpointing exactly what it does. But essentially, if you just take us through how you approach it or how you would define it, essentially, it's just everything in one network, from your toaster to your Fitbit to your car, as long as it doesn't get hacked.
Yeah, I mean, I think that, and I agree, it's pretty daunting if you think about it. But I think that if your question is how do we think about security, if it's that, I think the way that investors should think about it is the same way companies think about it, which is a layered approach, right? A notion that one technology isn't going to stop the adversaries from penetrating a network. And as these networks grow, you need, and I apologize for my voice, as these networks grow, you need more layers of security. And that's what we're seeing today, right? We're seeing just, think of it almost as, a castle, right? And a castle had a moat, and it had turrets, and it had places where you could put the little arrows through. That's what we're seeing in cybersecurity, is this layered approach, which results in a lot of spend. Because if you're a chief information officer, and by the way, the pressure on the board down to the CEO, down to that chief information officer is really, really high, right? I mean, all you have to do is open up the FT to see about a security breach. I mean, they happen weekly. So I think that the thing that cybersecurity has going for it is high awareness coupled with sophisticated adversaries, plus lots of spend needed to protect that franchise.
In that subsector, are there companies that you like in particular, stocks you like in particular, that concentrate on the IoT security that readers might want to research further?
Less so on the IoT specifically, but we like businesses where they have a chance to sell multiple products or multiple subscriptions to their customer. And the reason why is we constantly hear in doing our research is we want to do more with less on the customer side. Speaking back to our earlier comment about labor efficiency, because orchestration of multiple products that don't fit together is really difficult. It's not impossible, but it's very hard. So we're looking at the likes of companies that have a dominant product in a particular aspect of security, and then they layer on other services or they acquire another product. A company that comes to mind that I think is just incredibly well run is Palo Alto Networks, which is a rather large position for the trust.
Oh, okay, interesting. And of all these long-term structural growth themes, what excites you the most?
It's a little like asking me,
what your favorite child is.
What my children are like best. Look, I think that it's hard to pinpoint just one. I think thematically, whether it's the movement to hybrid electronic vehicles, because we have much better awareness about the environment today than we did in my generation when I was young, whether it's the movement to digital, which we've alluded to a lot on this conversation, whether it's movement to the cloud, whether it's the Internet of Things. Those are all really interesting opportunities and interesting segments for us to look at. And then overarching it all is this notion of cybersecurity is a tax that businesses need to pay across all aspects of their kind of technology infrastructure. So I mean, there's a few themes in there. It's hard for me to say what my favorite theme is. The interesting thing about technology is, if we have this conversation 24 months from now, there will be something new, and there'll be something, whether it's a consumer product, whether it's a business product, because the individuals that participate, at the company level are just so incredibly entrepreneurial and clever. And that's where I really feel like, I'm very lucky with my job to get to spend time with these women and men as they run their businesses and to figure out kind of how big they can be. I feel like that's a great part of my job.
Yeah, it certainly sounds it. The one thing that intrigues readers, and certainly me, is on the electric vehicle front. We read about how it's all going, the batteries, et cetera, lithium. And not too long ago, we had a piece about hydrogen. And so what I wanted to know, and I'm sure many readers would be curious too, is there something in the idea that you could get the hydrogen fuel cell electric vehicles going? Could they take off big time, or is that just more of a niche, or how important will it be?
Well, I think anything that can decrease our reliance on fossil fuels is a positive. I think the the hydrogen aspect of battery today is fairly nascent. It's not something that we're hearing a lot about. I too have read bits and pieces about it, but I don't think it's not in production today. Will it be in production over the next 5 to 10 years? Potentially. I just don't think it's the here and now, especially as volumes continue to rise on electronic vehicles. It really takes a large amount of batteries actually to fill that demand.
And possibly fossil fuels before we get to the green era to produce electricity, but that's another story.
That's another story.
Very big other story. Mike, is there anything else you'd like to tell us about? We've gone through all the intriguing subsectors, I think. Is there anything else you'd like to tell us about the outlook?
No, I mean, I just reminded. The only thing I would tell investors is just often remind myself to think about where are we going to be 12 months from now, 24 months from now, and obviously there's a series of steps that need to occur for that to happen. And my job and our team's job is really to figure out to position ourselves in a way to take advantage of those opportunities. And we're not going to always get it right, but over time, our process really lends itself to identification and monetization of these themes in technology. And I, whether it's our fund or another fund, exposure to technology is just something that I think every investor needs some aspect to, just given the inherent growth in technology as you compare it to other aspects of the economy. That's about it.
Certainly in a time of secular stagnation, as we feel it might be. Thank you very much, Mike. That was very, very informative and great fun.
Thanks for all your time.
And thank you very much for listening, everybody. And I'll see you at the next webinar. Thank you. Bye-bye.